Today we take a closer look at the company's capital structure, which is basically the combination of the debt and equity a company uses to finance its long-term operations. Each type of capital in the capital structure has different terms and rights conferred on the owner. From a bond investor perspective, the main focus when lending money to companies is to minimize the downside risk if something goes wrong. Depending on a company's operational outlook and the underlying assets on the balance sheet, we decide whether we prefer a better secured holding via senior secured debt or whether we are willing to go down the capital structure. This is the case whenever a high yield for a subordinated debt instrument compensates us well for the underlying risk. Let's first look at the corporate structure on the left-hand side. The outcome for senior debt can be very different depending whether you are secured or unsecured. Let's look at the example of Towergate. The insurance provider had too much debt on its balance sheets in 2014 and had to be restructured. The two lines represent the bond prices of senior secured and unsecured debt. As you can see, the recovery rate for secured debt that grants investors a claim over the physical assets of a company was significantly higher compared to the senior but unsecured debt. However, in a default scenario, holders of senior unsecured debt will get treated before holders of subordinated debt. Bond investors have also the opportunity to access a quasi-equity income stream by investing in so-called hybrids. Much like equities, hybrid bonds are perpetual in nature and allow the issuer a degree of discretion over coupon payments. The credit rating agencies assume a degree of equity benefit for the hybrid capital, which can enable support for an issuer's credit rating. At the same time, hybrids can be treated as debt for tax purposes. Given the additional risk to investors for subordinated or equity-like debt, there is a higher yield to compensate. Looking now at the bank's capital structure, you will see different layers. A bank's capital has layers of Tier 1 capital and Tier 2 capital. Tier 1 capital is a bank's core capital and is intended to measure a bank's financial health, whereas Tier 2 capital is a bank's supplementary capital. Let's start from the top there. The covered part includes, for example, bank deposits backed by the government or secured bonds, for example, backed by mortgages. The senior layer then consists uninsured deposits and senior unsecured bonds. For the latter, we see a trend away from OpCo senior bonds to HoldCo senior bonds, which makes it easier for the regulator to bail in creditors. Next in line is subordinated debt. Under the old Basel rules, you might have heard of lower Tier 2, which is subordinated debt with no deferrable coupons, as well as upper Tier 2 bonds, which are characterized by deferrable coupons and possible interest and principal write-downs. Today, this differentiation has mostly disappeared. Going even lower in the capital structure, we arrive at the quasi-equity bonds. In Europe, such bonds are known as AT1s, which for example can be contingent convertible bonds or in short, CoCo. Similar to equities, AT1 bonds offer the issuer discretion to skip a coupon payment. In addition to that, AT1s require from the issuing bank to maintain a specified common equity ratio. Should the ratio fall below this trigger point, AT1s can be written down or, in the case of CoCos, be converted into equity. Given these features, issuing AT1s helps a bank to meet its core capital requirements. The US equivalent to AT1s is, by the way, preferred shares, which do have a lot in common with AT1s. Preferred shares pay investors a specified dividend, which is actually the coupon you get. So, whenever you look at the bond, make sure you know where you sit exactly on the capital structure.